What in the world is a dividend snowball? You know, one of the questions we all have to face at some point is how do we want to invest our money in retirement? And there's as many different strategies as there are people out there. But one strategy is called the dividend snowball. I suspect many of us have not heard of it in the past. So I wanted to talk about it in today's video. I'm not saying this is right for you. This is not financial advice for your specific situation, but what is a dividend snowball and what are kind of the pros and cons and how do people think about it? So the dividend snowball really comes down to looking at dividend stocks as a core piece of your retirement portfolio. And the nice thing about quality dividend stocks is they tend to pay a pretty decent dividend income, right? It depends on the cycle and interest rates and things like that. But 3, 4, 4.5% for high quality companies tends to be what you see over various investment cycles. Good quality operating companies tend to increase their dividends at a rate faster than inflation. Now you got to be careful because there's a lot of bad dividend stocks. Dividends can be one way that poor companies attract investors is by paying out money to their investors. And in many cases, they're borrowing that money. And that oftentimes does not have a good ending. So operating companies that have excess cash flow and, you know, in general, maybe half of the money, maybe 2/3 of the money, the company is reinvesting in opportunities that they see internally in their industry, but the rest of it they're paying out to investors. Okay, so let's talk about this concept of a dividend snowball. And I want to start really with the idea of getting to your first $100,000, right? Because if you've got $10,000 and a stock pays 3% a year, you know, you're getting $300. And basically, the idea of this dividend snowball is, you know, it starts off small, just like a small snowball, but as it rolls downhill, it gets bigger and bigger and bigger. And it's the same thing with that $10,000. Maybe early in your career, you know, you look at $300 and say, I don't see why Azul is so excited about dividend stocks. And for a young person that's still building up their net worth, it may not be the best tool for them. But for somebody that's retired and wants truly passive income, doesn't want to have to worry about replacing water heaters and things like that with rental properties, or many of these other passive income strategies really require work. But owning a dividend stock, the work is really just making sure should you still hold this company. So yes, if you've only got $10,000, the $300 doesn't sound exciting, but at $100,000, you've got $3,000 at 3%. At $1 million, you've got $30,000 or $40,000 coming in. And not only that, but hopefully the company, if you've picked the right dividend company, not only are they paying out a dividend, but they continue to get more valuable with time. So oftentimes the strategy is, if you're married, you and your life partner are living off of the dividends and you're letting that nest egg grow, maybe as an inheritance for somebody or maybe as a safety net for you. So let's talk about the importance of getting your portfolio to grow. And the nice thing is, you know, getting to $1 million seems like a very daunting task, but let's look at this chart that says, how long does it take to save up $100,000? So you can see at the beginning here, the first $100,000 takes a little less than 8 years. You can see that what the investor put in represents 78% of that first $100,000, so $78,000. And the returns on that $78,000 that they put in funded the rest. But again, you can see the snowball is growing, right? The second $100,000 only takes 5 years, assuming you're continuing to put in $10,000 a year. And now it's roughly 50-50. Half of the money for that growth from 100,000 to 200,000, or really from day one, from $0 to $200,000, half of that money is money that the investor put in, but the other half, or almost half, 49%, is the growth that took place in the account. And that's what's referred to by the dividend snowball when you get to that break-even point. Let's look at the next 100,000. So this is going from 200,000 to 300,000. You can see that the investor put in 30% of that money, but now the existing investments are more than carrying their weight. And now it's doing 70% of the heavy lifting of the growth came from the existing asset base. And it just continues to grow, just like that snowball rolling downhill. The next 100,000, so to go from 400,000 to 500,000, now the investors put in 25% of that money, and 75% of that money is coming from the growth of the account itself. And I'm not going to go through all of these, but let's look at the final tranche of that, which is 900,000 to $1 million. You know, 900,000 to $1 million, the investor's putting in 14% of that incremental 100,000, and the account itself is putting in the 86%. So it's what Warren Buffett calls the magic of compounding interest. And it gets back to one of the main 3 tenets that I talk about on my channel to growing wealth, right? Is no matter how much you make, you have to spend less than what you earn so that you can save. But importantly, it's not enough to save. You also have to invest that money, because compounding, as we're seeing here, compounding is a great thing. And this is compounding working in favor of the investor. But you know what? That sword has 2 edges. And the other edge to that sword is if you put your money in the bank and it's getting less than inflation, what we're seeing here, the compounding in a good way, works in reverse too. So if your returns are less than inflation over a period of time, your money is losing money faster. I don't know where the analogy goes, but it's increasing, it's decreasing, it's losing money exponentially quicker each and every year. So be careful of that. But this is the snowball, the dividend snowball strategy. I think dividends has a powerful role in many retiree accounts, maybe not everything. Certainly you don't want to be exposed to the volatility. You won't want to, for most people, being 100% in dividend stocks when they're retired would be too volatile. It'd be too bumpy of a ride. Yes, they pay a nice dividend, but boy, it's going to take your breath away if that stock drops 30, 40, 50%. So it may be a piece. I encourage you to work with a fee-only financial advisor. I also encourage you to watch this video up here, which is kind of part 2. It talks about dividend stock investing and kind of what my personal strategy is in retirement for investing. And full disclosure, dividend stocks play a core role in that. Thanks for watching this one. I'll see you in the next video.